Silver gets smashed. 83.97 I show right now, up 571, and at 84 bucks, I mean, we were at 65 on Friday night. Now, what just happened was contrived. It's BS, should have never happened. Where were the circuit breakers? Oh, they have reasons why it didn't, and they're using the millisecond thing, a bunch of nonsense, right? They stop it when they want. This was contrived. It was done to either, at the same time, flush out all the speculators and bail out some of the short positions by the big money. You can't keep doing that. When you see this huge arbitrage going on in China, you can't do it. All of that metal will arbitrage away from the COMEX, from the LBMA. By March, you'll see silver back at all-time highs. The 30+% swing back, boom, no, why aren't people freaking out when it goes back up 30%? And immediately after the smash, tens of millions of ounces show up inside the ETF. David Jensen talks about 2 billion ounces of open interest contracts standing against 120 million ounces of physical. That is standing behind 400 million ounces of potential delivery. The exchange is being bled dry. I'm just looking to see what silver is at today. Haven't looked yet.
It was 83.5 last time I looked.
83.97 I show right now, up 571, and gold at 5,081.50, up 110 bucks. At 84 bucks, I mean, we were at 65 on Friday night. So here we are, you know, that's over 30% right back. I think what people need to understand is, you know, first of all, the CME group raised margins to all-time highs. Raising margins is, first of all, people think it's very bearish. In my mind, it's not bearish. It's the exchange telling you that this move is real and it's getting violent. It's bearish at first, because the amount of money needed to hedge positions increases exponentially. They've raised it twice right around Christmas, a few days before and the day after. It was like $18,000 to hedge 5,000 ounces of silver right around Christmas time. The day after, it went to 27,000 ounces, and now we're above $53,000, $54,000, $55,000 to hedge 5,000 ounces for a company like ours that would normally have 2 million ounces of silver in the warehouse. Becomes very expensive. You better have $50 million in your margin account, or you're not going to keep much in the way of hedged inventory of gold and silver.
Margin hikes rarely signal weakness. They usually confirm volatility has reached institutional concern levels. Andy Schectman has repeatedly pointed out that exchanges raise margins when leverage becomes systemically risky, not when demand disappears. Moving from $18,000 to roughly $55,000 per contract represents a threefold capital requirement jump in weeks, dramatically shrinking speculative participation. This matters because liquidity providers and hedgers must now allocate far more capital, tightening futures market flexibility ahead of key Q1 commodity positioning cycles. Andy Schectman believes these capital constraints often precede structural repricing phases in metals markets.
But this is also true of speculators. And, you know, the margins are a percentage of the contract's value. So when gold and silver go up, the contract gets bigger and the margin requirement goes up automatically. That's a new thing. It used to be a fixed rate. Now they're making it a percentage. So, you know, the math does this as the price goes higher. Okay, that's fine, but they're also adding volatility into the equation. And when the market starts getting swinging, like we're seeing up 30, down 30, they can raise the percentage that you need on margin, and that's when it really bites. And because now you're getting squeezed from both sides, higher prices and higher margin rates. But here's why it's bullish, and to me it's bullish because margin hikes don't stop physical demand. What they stop is paper leverage, and they force the weak hands out, and they reduce the ability to run giant positions just on thin collateral, where you can control massive positions by having a small margin account. And so, yes, you will get a paper flush when this is implemented like we saw, And futures can and did drop when the leveraged traders are forced to liquidate.
Percentage-based margin systems quietly amplify volatility during commodity bull cycles. Andy Schectman often explains that when margin requirements scale with price, leverage declines automatically even without regulatory intervention. That shift fundamentally changes market structure because speculative capital shrinks, just as institutional demand often accelerates, particularly during inflationary cycles like 2021 to 2024, commodities rallies. Historically, leverage flushes in metals markets, including the 2011 silver spike, removed retail traders, but strengthened long-term price floors. Andy Schectman warns this transition phase is where impatient investors usually exit before structural moves begin.
But that's not the end of the bull market, that's the shakeout. And the people that have been standing for delivery, as I've been really screaming about for quite some time now, for 15 straight months, so they're not using margin. And so these are the big money, the banks. Could it have been a one last attempt to bail out some of these U.S. banks who still had? Now, we've been talking about the Commitment of Traders report that said the U.S. banks are net long. We've talked about the report that came out of the Economic Times that said the banks are net long. But being net long doesn't mean you're long only. That means you have more long than you do short. Now, could this massive price rise and all of this attention that we've been seeing on silver precipitate some concerns by some very big players in a coordinated fashion? They raise margins and smack the crap out of it? Yes. But what they really did was they chased leverage out of gold and silver. And when you do that, you don't make those that are holding said metal weaker. In my opinion, you're putting it into stronger hands. And so, that's kind of the tell to me. And margin hikes don't end bull markets in metals. In my mind, they usually mark the point where the next leg higher becomes inevitable because now it's in strong hands and the price is now moving up.
Net long banks doesn't mean what most investors think it means. Andy Schectman frequently notes that commitment of traders' positioning reflects relative exposure, not directional conviction by institutions. Banks being net long, while exchanges raise margins, suggests risk management coordination rather than panic, something seen during commodity stress periods like March 2020 liquidity events. Delivery demand continuing for 15 months indicates capital with balance sheet strength is replacing leveraged futures speculation. Andy Schectman says when physical demand persists through volatility, markets often transition from paper pricing to supply-driven pricing dynamics.
I want to give you kind of what I mean by that too. So this is kind of one of the moments where the market confesses. And you had the biggest one-day drop in silver maybe ever. And everyone got emotional. People are screaming and panic and, they assume demand vanished. But this is how these idiots work, okay? The very next day, SLV takes in the largest one-day metal inflow in years. Dunnigan, that's not panic buying. That's institutional metal transferring at a discounted price. And what I mean by that is that you had 550 million shares outstanding the day before it dropped. The day after, it goes to 587 million. So that's a 36.3 million new shares that were created at roughly 0.905 ounces per share. That's about 33 million ounces of silver added in one day. And the authorized participants are the only one who can create those shares, and they can only do so by delivering physical metal first. So think about really what that means. Silver gets smashed, and immediately after the smash, tens of millions of ounces show up inside the ETF.
Panic selling headlines often hide institutional accumulation happening underneath. Andy Schectman has explained that ETF share creation requires physical metal deposits, meaning inflows represent supply movement, not speculation alone. Adding roughly 33 million ounces in one day suggests balance sheet level buyers stepping in during forced liquidation. similar to ETF accumulation patterns seen during the March 2020 commodity shock. Retail investors usually interpret price drops as demand collapse, while institutions treat them as liquidity windows. Andy Schectman says ETF metal inflows during price crashes often reveal who is actually gaining control of supply.
This tells you that someone with a real balance sheet used the forced liquidation, this margin event, to source physical metal cheap and park it where they control it. And they control it inside of the ETFs. And this is metal migrating from forced sellers to the institutional vaults because these institutionals can do what's called share redemption, and they can redeem their shares if you're an authorized participant in metal, and it's far more opaque than it is transparent. And it's just another mechanism they have to drain physical metal out of the ecosystem. But when you line up the delivery pressure that we're seeing, the tightness in the registered inventories, which I want to talk about in a moment, all of this stuff, including what's going on in the ETFs, this is not normal flow. That's inventory reshuffling under what I think is major stress. And, Richard Russell used to say something like this to me. He used to say that markets don't reveal themselves during the violence. They only reveal themselves after. And where price is the weapon, freaks everyone out, but the inventory is the confession. The confession is we really don't have it.
The real story isn't price volatility. It's where the metal quietly moves afterward. Andy Schectman has argued that ETF redemption mechanisms allow institutional players to convert paper exposure into physical control without public visibility. When inventories tighten while ETF holdings grow, it suggests supply consolidation rather than broad demand expansion. Historically, commodity stress periods, like the 2008 financial crisis, showed similar inventory migrations into institutional vault systems. Andy Schectman says investors should watch inventory flows more closely than price charts to understand who is gaining control.
But we need to freak everyone out by flushing them out with price and margin increases. But nothing has changed. In fact, now you get into this Project Vault that's come up where you got the U.S. government that is acting very much like silver is not plentiful. It's acting like it's strategic. Of course, they call it a strategic metal right now. We've had 6 straight years of a deficit, of course. It's been added to the critical mineral list, but now you got this Project Vault, a brand new U.S. critical mineral reserve. It's obvious that they're worried about disruptions, and they call it a public-private structure designed to stockpile essential raw materials inside the United States to protect supply chains. That means they want to incentivize domestic mining also. So you put a floor under the price. And then you zoom out, you look at COMEX registered as the delivery pile, which is massively lower than a few years ago, and the LBMA is being bled dry. Demand is rising, supply is constrained, and the world is treating silver like it's a strategic input.
Governments only stockpile materials they fear becoming scarce during geopolitical or industrial disruption. Andy Schectman has emphasized that being placed on the US critical minerals list signals national security importance, not just commodity demand growth. 6 consecutive global supply deficits suggest structural imbalance, particularly as solar manufacturing and electronics demand accelerate into 2026. When governments incentivize domestic mining while inventories decline at COMEX and LBMA, markets often interpret that as a long-term supply concern rather than short-term volatility. Andy Schectman believes strategic classification often precedes sustained repricing cycles.
They're admitting this right now. And so I think that, when governments start stockpiling, the message is simple. The scramble for the real stuff has begun. And if that's really what they're going to do, you better clean up your balance sheets if you're wickedly short. Maybe that's what this was about. But I can tell you that nothing changed. There are no fundamentals that changed at all. In fact, maybe they're even getting stronger. And what I mean by that, last thing, and I'll take any questions that you have, the March silver contract is really shaping up to be really interesting. Right now, the March silver contract open interest, meaning contracts that could stand for delivery, is between 80 million and 81 million, right around 80,500,000 contracts open interest. Now, I suppose that kind of sounds abstract until I tell you that each contract is 5,000 ounces of silver. So that's over 400 million ounces of paper silver that is tied to the March contract. The first day that they can stand for delivery is the 27th of this month, so 2.5 weeks away.
Open interest numbers sound abstract until converted into physical supply comparisons. Andy Schectman often explains that futures markets can represent multiples of available metal, creating perception gaps between paper supply and physical inventory. Over 400 million ounces tied to one contract month highlights how leverage dominates commodity pricing structures. Delivery windows like February 27 often become stress points, when participants must choose between rolling contracts or demanding metal. Andy Schectman says these moments reveal whether futures markets reflect real supply or simply financial positioning.
But if you compare that to what is actually sitting in the COMEX, the registered category as of yesterday is 103.5 million ounces registered, meaning ready for delivery metal is 1 out of every 4. Is that right? 1 out of every 4 ounces, 402 million ounces could stand for delivery, standing against 103.5 million ounces. Now, typically, most of these contracts will roll forward or cash settle, but if even 10% of the March open interest stands for delivery, that's 40 million ounces. If 20% stands, that's 80 million ounces. Suddenly, you're looking at a massive chunk of the registered category, and the market has to react. So the bullish bet isn't that COMEX defaults. I think it's simpler. I think that it's the price of immediacy rises, backwardation, the spreads tighten, and the market has to pay up or pull metal out of the eligible category, which is the other side of COMEX, which right now has 294 million ounces. So we have a Brinks account in New York City, JFK, one of our 8 Brinks facilities. That's COMEX.
Delivery pressure rarely causes exchange default. It usually changes pricing behavior first. Andy Schectman has noted that when registered inventory covers only a fraction of open interest, markets shift toward backwardation and higher spot premiums. With roughly 103 million ounces registered versus potential delivery claims near 400 million ounces, even modest delivery demand could tighten spreads quickly. Commodity markets historically respond by raising immediate delivery prices rather than failing operationally, as seen during multiple energy and metal squeezes since 2019. Andy Schectman says pricing pressure often appears before supply shortages become visible to investors.
It's the only one of our 8 Brinks facilities that is a COMEX facility, and we have plenty of people with 1,000-ounce bars in those accounts. Those are eligible. They're not for sale. They could be because they are COMEX eligible. They're in the ecosystem. But no one's going to sell on my side. And all the people that are holding them ineligible, that's not for sale. So even if all of that metal went in, you're talking right now 294 and 103. You're about 99% of open interest right now. And it's all gone. But most of that eligible stuff isn't for sale. The point I'm getting at is that you see what's happening in London. We see that. We've talked to David Jensen, talks about 2 billion ounces of open interest contracts standing against 120 million ounces of physical. You see it right here, 103 million ounces of physical that is standing behind 4 million ounces or 400 million ounces of potential delivery. You see the exchanges being bled dry in Shanghai. You're seeing games being played on the ETFs. You're seeing margin hikes. And all along, the big money doesn't give a flying you-know-what. They just keep standing for delivery.
The paper to physical gap in metals markets is larger than most investors realize. Andy Schectman highlights that COMEX open interest can represent multiples of available deliverable metal, sometimes exceeding supply ratios seen during the 2020 liquidity crisis, when London reportedly has roughly 120 million ounces backing billions in contracts. It exposes how futures markets function more like liquidity systems than inventory systems. Margin hikes historically signal stress. Similar actions occurred during the 2011 silver spike. Investors should watch delivery demand carefully. He believes the imbalance matters.
It's the traders who think that they can play in this sandbox with these people who our money doesn't mean anything to them. And you may be very well heeled. You know, our company is very well heeled with the ability to have a massive inventory and the margin requirements needed for it. But if it kept going up, how much can we post? At what point does it just destroy the ability to maintain an inventory? So what they're doing is they're squeezing out the players who think that they're big enough to play in this game. And really what is happening is you are seeing a strategic repricing that is forcing out the speculators and putting it into the hands of the big money, who is standing for delivery. What more do you need to see but that? It's painful, it's scary. Fear is a very, very strong emotion, probably the strongest. And when you see this fall, you get emotional. This is why there's Elliott wave theory and Kondratiev wave theory, the mass emotions of the herd. Separate yourself from your emotions and look at the reality. Nothing's changed. In fact, every day it's getting more and more and more obvious that this is where you need to be.
Margin pressure often removes traders faster than price declines themselves. Andy Schectman is pointing to a classic liquidity squeeze dynamic where rising margin requirements push leveraged participants out of futures markets. This happened during the March 2020 commodity liquidation, when volatility forced funds to exit positions regardless of conviction. When capital-rich players absorb inventory during forced selling, ownership concentration increases. Investors should recognize that emotional selling often coincides with structural repositioning phases in markets, something Andy repeatedly warns about.
Now, what just happened was contrived. It's BS, should have never happened. Where were the stops on the
circuit breakers on the market, yeah.
The circuit breakers. So they have reasons why it didn't, and they're using the millisecond thing, a bunch of nonsense, right? They stop it when they want. This was contrived. It was done to, I think, probably, either at the same time flush out all the speculators and bail out some of the short positions by the big money. You can't keep doing that. When you see this huge arbitrage going on in China, you can't do it. All of that metal will arbitrage away from the COMEX, from the LBMA. If I had to guess, now I'm really stupid to say this, and I'm actually reluctant to say it, but I will say it. If I had to guess, by March, you'll see silver back at all-time highs. If I had to guess. Now, what do I know? But based upon what I see, the 30+% swing back today, boom, no, where aren't people freaking out when it goes back up 30%? Yeah, we'll get back up there.
Market structure failures often matter more than price volatility itself. Andy Schectman's frustration echoes concerns raised after the 2010 flash crash, when circuit breaker rules were rewritten to prevent algorithmic cascades. Claims of contrived moves reflect a deeper fear that derivatives markets can temporarily override physical supply signals. China's commodity exchanges have increasingly influenced price discovery since 2022 through arbitrage flows. For long-term investors, volatility spikes often mark liquidity stress rather than trend reversals, something he believes investors must understand.
I think it'll be buyer before March, if I had to guess. And all that happened is that the metal went from weak speculative hands who were holding lots of leverage to the big money that says, thank you so much for that discount. By the way, I won't be standing for any margin. I'm just going to pay cash for it. And if you look, who covered almost 700 contracts at 5,000 ounces apiece at the very, very bottom? Oh, that's right. It was JP Morgan. How foolish of me to think otherwise. You get it? The big money is still in control, but they are showing you where this is going. Not ending the bull market, just kind of showing the big traders who's really in charge, and that is the big money, until things get to a point where it's no longer about the ability to control things on paper. It's more about really who's got the physical. But there has to be a transition to get there. And I think that's what we're seeing right now.
Ownership transfer during panic selling is one of the oldest market patterns. Andy Schectman points to JP Morgan covering roughly 700 contracts, about 3.5 million ounces, which reflects institutional positioning during volatility events. Similar accumulation behavior appeared during the 2008 commodity collapse before metals rallied strongly into 2011. When leverage exits and cash buyers step in, market control often consolidates among fewer participants. For portfolio investors, watching who buys during declines matters more than price headlines, Andy Schectman argues.